It's all connected. Now it should be better. Now, are you able to hear me? Yes, there was, the mic was a little loosely connected. Now I think it should be fine. Give me a confirmation. Now fine. Yes, right? Perfect. All right. So I was saying that this is the March 2021 mock test paper that we are solving. All right. We in the earlier video we finished the MCQs, and in this video we are going to do the descriptive questions. All right. Let's begin. Here again there are very good questions. So we will solve each of these questions one by one. I request all of you attending the session live to make sure you all are interactive in the chat box, and please keep solving along with me. Just watching the lectures will not be as effective as actually solving along with me. All right. So without wasting any more time, let's begin. The very first question. Let's read what it says. You are required to compute the total income and tax payable. Okay, we have to compute total income and tax liability, remember, of Mr. Alok, who is 58 years old. He is a resident individual. He's an advocate. Guys, he's an advocate. Does something strike your mind? Advocate, a professional. He's a specified professional. So maybe section 44 ADA, the presumptive taxation section for professionals, may apply. He furnishes you the receipts and payment account for financial year 2021. They have given us his receipts and payments account. They have given us a whole set of adjustments. And then they are saying, assume Mr. Alok is not willing to opt for 115 BAC, which means regular provisions of income tax we will be applying. They have asked us to compute his total income and tax liability. All right. So what I will do is that I will start working out the question. All right. We'll keep making our calculations then and there simultaneously. All right. So that is how we are going to proceed with this question. No point reading the whole question first. As we read, we'll keep making our adjustments here and there. So first of all, I'm going to do the computation of total income. So give the heading in your notebooks. Computation of total income of Mr. Alok. We are doing the calculation for previous year 2021, assessment year 21-22. Okay, please keep writing along with me. Now under this, make a 3-columnar table. We'll make a broad particulars column, and then a narrow working note column, and then an amounts column. Now let's read the question. As and when we come across adjustments, we'll keep putting them down. Now he's an advocate and they've given us a receipts and payments account. Look at the receipt side first. Opening balance 80,000, fine, nothing to do. Cash at bank 80,000, okay. Fee from legal services. It shows the assessee has professional income, right? So professional income will go to which head? Professional income goes to PGBP. So under particulars, write on PGBP, give reference to working note number 1, all right? Leave some 10 to 12 lines gap and open the first working note number 1, PGBP. Now in this question, PGBP computation does not depend upon P&L account. Had it depended on P&L account, we would have taken net profit as per P&L account. We would have added expenses debited but not allowed. We would have added incomes not credited but taxable. We would have done all that, allowances, disallowances, all that we would have done. But here in this question, instead of giving us a P&L account, they have given us a receipts and payments account. So in a scenario like this, how are we going to do the calculation? If they give us the receipts and payment account, here we will take all the taxable incomes, and from that we will subtract allowable expenses, right? That is how we will be able to compute our business income. You agree with me? Had they given us a P&L account, We would take net profit as per P&L account. We would subtract expenses debited, but we would add expenses. We would add expenses which are to be disallowed. We would then add incomes which are not credited but taxable. We would subtract exempt incomes. All that we would do had they given us a P&L account. But here they've given us a receipts and payments account. So we will take all the taxable incomes, and from those taxable incomes, we will subtract all the allowable expenses, and that is how we will get PGBP. So my assessee's fee from legal services. Fee from legal services is definitely a professional receipt. So fee from legal services, write down. What is the amount? 49,60,000. Are you noticing the gross receipt is within 50 lakhs? Therefore, 44 ADA also is applicable. So PGBP, what we will do is that first we will do the calculation as per the normal route, the usual route. Then we will also apply 44 ADA, the presumptive taxation route. By 44 ADA, number one, assessee is an advocate. Advocate is a specified profession. And number two, the assessee's gross receipt is within 50 lakhs, only 49,60,000. Therefore, 44 ADA is definitely applicable. So we'll first do the calculation as per the normal route. Then we'll calculate as per 44 ADA. We'll pick whichever gives us the least income. Okay, remember, we'll have to do that. Then motor car loan. Assessee has borrowed a loan to buy a car from SBI, 12% per annum interest. Okay. We'll see if they talk about interest expense. Right now, nothing to do. Then they are, I'll anyways highlight this NK, because here we don't know whether my assessee is paying interest or not. I'll highlight and keep this. Later, we'll come back to this adjustment. Sale receipt of 5,800 listed equity shares sold on 31st March 2021, 5,95,000. What has happened over here? My assessee has sold some shares, listed equity shares on 31st March 2021. This will go to which head of income, guys? This will go to which head of income? This will go to capital gains, isn't it? So come back to your main answer. Under PGBP, write down capital gains. Okay. Give reference to working note number 2. After your PGBP working note, open a new working note number 2. Give the heading capital gains. Okay. Under this, write down capital asset being transferred. What are we selling? What are we transferring? 5,800 listed equity shares. Write down 5,800 listed equity shares. What is the period of holding of these shares? We don't know. They haven't mentioned when did we purchase these shares. They have just mentioned the sale date. So we'll wait and see when was it purchased. It was sold on 31st March 2021. So we don't know whether it is short term or long term. We'll have to wait and see. Now, how do we compute capital gains? We start with the full value consideration. And full value consideration number, they have already given us sale receipt. By selling these shares, we got 5,95,000. So the sale receipts, the full value consideration from the sale of these shares is 5,95,000. Okay. Now let us see the other information on the payment side. Staff salary and bonus to clerks. This will go to which head? PGBP. It's an expense connected to my profession. So below this, subtract the staff salary. How much do you have? 17,50,000. Okay. From this, we have one more expense to subtract. Other general and administrative expenses. So write down other expenses. How much? 22 lakhs. Let's assume it is all connected to our profession. Then office rent. So subtract office rent. How much office rent is my assessee incurring? 1,48,000. Subtract that. Then assessee is paying life insurance premium. Sum assured is 5 lakhs and he's paying 49,000. At the maximum, you can pay 10% of your policy as 10% of your sum assured as life insurance premium. 10% of 5 lakh is 50,000. He's paying well within 50,000. Hence, seems to be fine. Life insurance premium will go to which section? This will go to section 80C. So I'll open another working note after your capital gains working note. Open working note number 3. Give the heading chapter 6A deductions. All right. Assessee is paying life insurance premium. This will go to section 80C. So under this, write down section 80C, life insurance premium. How much has my assessee paid? He has paid 49,000. This 49,000 is well within the limit of 10% of sum assured. 10% of sum assured would be 50,000. It is well within that limit. Hence, this entire 49,000 will be eligible for section 80C. All right. This is about life insurance premium. Then he has paid for a car, motor car acquired in January 2021 by way of NEFT. NEFT is nothing but electronic transfer of funds. This does come under specified mode because specified mode covers account pay check. It covers account pay bank draft. It covers ECS and it covers other specified modes, other electronic modes, isn't it? NEFT is covered under other electronic modes. So my assessee is incurring 9,50,000 to purchase a car. So relating to this, any adjustment applicable? We'll have to charge depreciation, isn't it? Let's assume that the motor car is being used fully for the purpose of profession. So I will allow depreciation on the car. How to calculate? We spent 9,50,000 to acquire the car. Can you tell me what is the depreciation rate for car? Do you remember? It will come under 15% plant and machinery block, right? And here I purchased the car only in January 2021. Which means definitely I would have put it to use for less than 6 months, for less than 180 days. Therefore, I will get depreciation only for half the year, right? I would have definitely put the asset to use for less than 180 days. Hence, I will get only half the year's depreciation. So come on, do the math. What is the depreciation? Do you get 71,250? Yes. See, the way I'm solving the question, this is exactly how you should do in the examination. Don't spend time reading the entire question, making judgments, then starting to work out. Too much time gets consumed. Total income questions when you get, see what have they asked you to calculate. Read the question. As you read the question, keep making adjustments here and there. Okay, open all working notes simultaneously, make adjustments here and there. Once you finish reading the question, close each working note, close the answer. When you do this, there is a possibility that 1 or 2 adjustments you may have to score off and redo. It is fine. At least the total time that you will take will be way lesser than reading the entire question, deciding what steps you will follow, then working out. That will take way too much time. So in this method, which I follow, the only drawback is that you may have to score out something sometimes. That is okay. That sort of risk we can take. And don't be scared of scoring off something. You don't get any extra marks for neatness in your paper. Doesn't matter. It's a professional examination, right? As long as the examiner is able to read what you have written, as long as the examiner is able to understand your writing, that is enough. So car depreciation we have provided at 15% and only for half the year. Why did we provide it for only half the year? Because the car was being put to use for less than 180 days. All right. So this is about the depreciation on car. Then books bought, again, how account paycheck specified mode. In the month of May, June and September, annual publications. Even on books, we get depreciation. Depreciation at what rate? Does anybody remember? I'm going to wait for your response. Come on, quickly tell me. What is the depreciation rate for books? Annual publications. I'll give you a hint. It is the same as computer. Now do you remember? 40%, right? So write down less depreciation on books. How much are we investing for books? 80,000. 80,000 into 40%. When did we acquire them? May, June, and September. May, June, September would definitely be more than 180 days. So I will get the full year's depreciation. So 80,000 into 40%, I will get 32,000 depreciation relating to books. Okay, then computer acquired on 1st November 2020 for professional use, payment made by account pay check. Good, payment is made by specified mode, because had payment not been made by specified mode, then depreciation is not eligible, isn't it? You don't get to add the asset to the block if the payment is made by non-specified mode. So here, if you see, there are three assets: car, books, and computer. And for all the three, payment is being made by the assessee in specified mode. So we get depreciation. So even for computer, we will calculate depreciation. So write down depreciation on computer. How much are we spending? We are spending 52,000. What is the rate of depreciation for computer? 40%. When did we put it to use? We acquired it only on 1st November 2020. So definitely we would have put it to use for less than 180 days. Because less than 180 days, I will get only half the year's depreciation. So how much does that work out to? 10,400. Please keep checking my numbers. Yes, 10,400. All right. So this is about depreciation on computer. Then domestic drawings, personal expenses, nothing to do. Motor car maintenance, this becomes my professional expense, isn't it? We are assuming the motor car is being used for the purpose of profession. So motor car maintenance, how much did we incur? We incurred 72,000. We'll get as a deduction in computing PGBP. Then public provident fund. Public provident fund will go to which section, guys? You know, definitely you know the answer. Public provident fund will go to section 8EC, right? So you already opened a chapter 6A working note. So there under section 8EC, write on public provident fund. How much are we investing in PPF? We are investing 1,50,000. Okay. Closing balance, fine. Now let us see the other information. We'll keep seeing one adjustment and we'll keep finishing it off. What does it say? Listed equity shares. Okay, so they're talking about the capital gains adjustment. They're saying listed equity shares on which STT was paid were acquired in August 2016 for 1,21,800. So we found the date of acquisition. When did we acquire these shares? We acquired these shares in August 2016. And we are selling them on 31st March 2021. Listed equity shares. Can you tell me what is a relevant period of holding for listed equity shares? Will it be 12 months? Will it be 24 months? Or will it be 36 months? What do you think? Come on, quick answer. What would be the relevant period of holding for listed equity shares? Definitely you would tell me it is 12 months. And this period is definitely more than 12 months. Hence, what kind of an asset do we have now? We have a long-term capital asset. All right. So listed equity shares on which STT was paid. Guys, listed equity shares, long-term, STT is paid. Does any section strike your mind? Think and tell me. Does any section strike your mind? Listed equity shares, STT paid, long-term capital asset. Which section strikes your mind? Section 112A, right? So we'll have to apply section 112A over here. Do you remember what section 112A says? Cost of acquisition, even though long-term, no indexation, right? And in case I purchased the shares before 31st Jan 2018, then how do I find cost of acquisition? It will be the actual cost of acquisition or FMV on 31st Jan 2018, or FVC, these two numbers, whichever is lesser, cost of acquisition, or this lesser number, whichever is higher, right? And up to 1 lakh, no taxation. Beyond 1 lakh, on the excess, you have to pay tax at what rate? 10%. Basic exemption limit, you can adjust. Chapter 6A, not allowed. Rebate under section 87A also not allowed. This is what we have discussed already under section 112A. So here my capital asset is 5,800 listed equity shares on which STT is paid. These shares were held for more than 12 months, hence long-term capital asset. What else does the question say? The question says they were purchased for 1,21,800. FMB on 31st Jan and on 1st April 2018, they have given to us. All right, so with all this information, we can finish off the computation of LTCG. So from full value consideration, we subtract expenses on transfer. Do we have any expenses on transfer over here? No. I have a question for you at this stage. Tell me, had they given us in this question how much STT is paid, would we have subtracted STT as expenses on transfer? Yes or no? Can we subtract STT as expenses on transfer? Yes or no? Come on, quick answer. Can we subtract STT as expense on transfer? Big no. In the entire Income Tax Act, there is only one place where you get to subtract STT. And what is that? In PGBP. PGBP also, when will you be allowed to subtract STT? Only if you are a share trader. If you're a share trader, STT will be your business expense, and that is the only place where you will be allowed to deduct STT. In no other head, in no other scenario, never are you allowed to subtract STT under Income Tax Act. The only place where you are allowed is under PGBP, and that too only if you were a share broker. All right. So remember this. Here we don't have any expenses on transfer. So what is our net consideration, guys? This 5,95,000 entire thing becomes a net consideration. Now my asset is a long-term capital asset, but still I am not going to index the cost of acquisition. But why? No, because it is section 112A case. In section 112A, even though my capital asset happens to be a long-term capital asset, still we don't get any indexation benefit. So I will straight away subtract cost of acquisition. Now, how to compute cost of acquisition? We purchased shares in August 2016, which means we had purchased them before 31st Jan 2018. Whenever you purchase the shares before 31st Jan 2018, you have a special method to compute the cost of acquisition. Right? Let us do that calculation over here. I'll just make a rough calculation over here. So the date of acquisition is on or before 31st Jan 2018. Therefore, how do we compute the cost of acquisition? I will first see the actual cost of acquisition. What is the actual cost of acquisition, guys? Listed equity shares were acquired for 1,21,800. So 1,21,800, my actual cost of acquisition. Then I will do two more things. I will see what is the full value consideration. Full value consideration is 5,95,000. I'll see what is the FMB on which date? FMB on 31st Jan 2018. What is the FMB on 31st Jan 2018? FMB on 31st Jan 2018 was 75 per share. So 75 rupees into how many shares are we talking about? 5,800 shares, right? So the FMB will be 4,35,000. Are we all clear? We will see the actual cost of acquisition. We will see what is the FVC number. What is FMB on 31st Jan 2018? Out of these two numbers, we will pick whichever is lower. Which is lower? 4,35,000. Out of these two numbers, we will pick whichever is higher, which is 4,35,000. Did you understand this? Yes, are we clear with this? My actual cost of acquisition is 1,21,800. My FVC is 5,95,000. My FMV is 4,35,000. Out of these two numbers, I will pick whichever is lower, that is 4,35,000. And out of these two numbers, I will pick whichever is higher, that is 4,35,000. So my cost of acquisition is going to be 4,35,000, no indexation, nothing. All right. And do we have any cost of improvement over here? No. So what is my capital gains now? 1,60,000. This is what our LTCG will be. Done? Yes. So with this, we are done with the first adjustment. Now, second adjustment. Motor car was put to use for both official and personal purposes. Motor car was put to use for both official and personal purposes. 1/3 of the motor car is for personal purpose. Let's discuss till here. What did we do? In PGBP calculation, depreciation on car was one expense relating to the motor car, and motor car maintenance. Both these we allowed fully. But then the question says 1/3 of the car is used for personal purpose. So we should subtract how much? Only 2/3 we should subtract. This is the kind of correction I was telling you may be possible. I was telling you, right? There may be some adjustments which you may have to redo. These are the kind of adjustment I was talking to you about. So 1/3 is being used for personal purpose. So I will subtract only 2/3. Right? Even motor car maintenance and depreciation on car. These are the only two expenses relating to car. So both these expenses, we will subtract only 2/3. Do not be scared of scoring off like this. Nothing happens. So how much will you get now? Your depreciation will be 47,500. And the motor car maintenance is going to be 48,000. All right. Okay, we will subtract only 2/3 of the expense. Why? What about the balance? The balance 1/3 is for personal purposes, and personal expenses are not subtracted in the computation of PGBP. All right, so this is it about the second adjustment. Then they say no interest on car loan was paid during 2021. Remember, we had kept this pending. We had seen this adjustment, we had kept it pending. They are saying that yes, we did borrow a loan, but in the current year, we haven't paid any interest. We didn't pay any interest, nothing to do. And mostly my assessee is a professional. Professionals generally follow cash basis of accounting, isn't it? So in cash basis of accounting, you subtract expenses only when you actually pay for them. Whether you incurred, did not incur, doesn't matter. When you pay for the expense, that is when you take a deduction, especially when you follow cash basis of accounting. Assessee is a professional, he would be following cash basis of accounting. He did not pay the interest, so we will not take the deduction. This is it about the second adjustment. Now talking about the third adjustment. Mr. Alok purchased a flat in Kanpur for 35 lakhs in July 2013, cost of which was partly financed by a loan from Punjab National Housing Finance Limited for 25 lakhs, his own savings of 1 lakh, and a deposit from Repco Bank for 9 lakhs. Let's try to understand what the question says. The adjustment says that Mr. Alok has spent 35 lakh rupees and he has purchased a flat in Kanpur. Now, how did he get this 35 lakh rupees? He took a loan from Punjab National Housing Finance Limited. He took a loan of 25 lakh rupees from here. He put his own money of 1 lakh and he also took a deposit from Repco Bank, 9 lakh rupees. So these are the three places from where he arranged money and he bought a flat in Kanpur. And what did he do with this flat? This flat he gave to Repco Bank on lease, which means what does my assessee have now? My assessee has a let out property now. Do you agree with me? Yes, my assessee has a let out property. Let out property, he is giving a property on rent. The rent will go to which head? we will have IFHP. Municipal taxes 8,200, house insurance 11,000. As per interest certificate issued by Punjab National Housing Finance Limited, he paid 1,80,000 towards principal and 2,01,500 as interest. So my assessee has the IFHP head also. Come back to your main answer. After capital gains, write down IFHP. Give reference to working note number 4. Working note number 3, we've already opened chapter 6A. After the third working note, open working note number 4, give the heading IFHP. It is a let out property. For a let out property, we start the calculations with gross annual value. To compute gross annual value, we need the municipal value, fair rent, standard rent and all. All those numbers are not given to us in this question. So when they're not given, we straight away take the actual rent number itself as a GAV. What is the actual rent in this question? 35,000. So my GAV is going to be 35,000 per month for 12 months. How much does that work out to? 4,20,000, right? From this, we subtract municipal taxes paid. What is the amount of municipal taxes which my assessee has paid? Only what you actually pay you consider. Municipal taxes paid is 8,200. So we will deduct that. And what does our net annual value work out to? Net annual value would be 4,11,800, right? From this, we subtract deductions under which section? Deductions under section 24, right? We have two deductions. Number one, we will have a standard deduction. Make sure you show the calculation. Standard deduction will be 30%. So 4,11,800 into 30%, which works out to 1,23,540. And then we also have another deduction, that is interest on borrowed capital. The question says, as per the interest certificate issued by the bank, he paid 1,80,000 towards principal. Housing loan, principal repayment. Does any section come to your mind? Housing loan, principal repayment. Section ATC, right? So come to your chapter 6A under ATC, housing loan, principal repayment. How much did we repay towards principal? 1,80,000. Always remember, housing loan, principal component will go to ATC, interest component will come to IFHP section 24. How much interest has he paid? 2,01,500. Tell me, should I restrict this to 2 lakh? I'm going to wait for your answer. Should we restrict this to 2 lakhs? What do you think? No, right? Because the restriction is applicable only to self-occupied properties. Let out property, no limit on interest. So the entire 2,01,500 I will subtract as interest on borrowed capital. So what is our income from house property? Do your math. You get 86,760. Yes. This is our income from house property. Correct? So this is it with a adjustment on IFHP. Now going ahead, my assessee has also earned 1,20,000 in share speculation business, speculation income, and lost 1,80,000 in commodity speculation business. So speculation profit 1,20,000, speculation loss 1,80,000. Tell me the provision relating to this now. Tell me, can we set off speculation loss against speculation profit? Of course, yes. Can we set off speculation loss against non-speculation profit? No, we cannot. So my assessee has made a speculation profit of 1,20,000. Against this, I will adjust speculation loss of 1,20,000. The balance speculation loss of 60,000. I have no choice. I'll have to carry it forward to the next year. Tell me, speculation loss, I am allowed to carry forward totally for how many years? Only for 4 years, right? Speculation loss only for 4 years you can carry forward, and you can set it off only against speculation gain. So remember this. Now in your PGBP calculation, leave some gap, leave some 1 or 2 lines gap, and then show this calculation. Write down speculation profit 1,20,000. From this, subtract speculation loss. Make sure in brackets you write down restricted, because you need to tell the examiner that actual speculation loss is more. It's 1,80,000, but I'm restricting it to 1,20,000. So how much are we left with now? 0. Remember, at the end, we'll put a note on share speculation loss being carried forward. Okay, I've highlighted this. We'll put a note on this a little later. Okay, now going to the next adjustment. Mr. Alok received a gift of 21,000 each from 4 of his family members. Which head of income will this go to? Obviously, you know the answer. It will go to IFOS. And will it be taxable? Yes. Cash gift, aggregate, you see. Aggregate of all the gifts, all the cash gifts put together. It is from his friends, so taxable. 21,000 into 4 will definitely be more than 50,000. All right. So come to your main answer. After IFHP, write down IFOS. Give reference to working note number 5. After your 4th working note, open another working note. Give the heading IFOS. Under this, write down cash gift from friends. Show the calculation. How much did we receive? 21,000 we received from 4 friends. So our total value of the gift is going to be 84,000. Definitely more than 50,000, hence taxable. Then after this, the next adjustment, he contributed 1,21,000 to PM CARES Fund by way of bank draft. What do you think about this payment? Which section will this go to? This is definitely going to section 80G. Now under section 80G, which category will this go to? 100% allowed without any limitation, right? So section under chapter 6A, write down, leave some gap after 80C, and then write down section 80G PM CARES Fund. Section 80G says you should make the contribution, you should make the donation beyond 10,000 in a non-cash mode. Yes, he has paid by way of bank draft, which is a non-cash mode, hence perfect. So the entire 1,21,000 will be allowed under section 80G. Okay. Then he donated to a registered political party 3,50,000 by way of check. Donations to political parties go to which section? Individual is donating to political party. Section 80GGC. Write down under chapter 6A, section 80GGC, donation to political party. 80GGC says the contribution should be in a non-cash mode. Yes, assessee has made the contribution by check, non-cash mode. Entire 3,50,000 allowed. He follows cash system of accounting. Oh, this we already spoke about earlier itself. That is it with the question. Now what we will do is that we will close each of the working notes one by one. All right. And then after that, we will do the tax liability calculation. Okay. Come to PGBP first. Calculate and tell me what is your PGBP number. Do you get 7,24,100? And then including the speculation adjustment also, my final PGBP is 7,24,100, right? But then because my assessee is a specified professional advocate and his fees is less than 50 lakhs, we'll apply section 44 ADA also. As per section 44 ADA, what will the PGBP be? Do you remember how to calculate? PGBP will be straight away 50% of gross receipts. Gross receipts are 49,60,000. 50% of this, you will get 24,80,000. So, if we don't follow 44 ADA, normal provisions if we follow, our PGBP is 7,24,100. If we do follow 44 ADA, our PGBP is 24,80,000. So obviously, what would you prefer, guys? So obviously, we would prefer not to follow 44 ADA. But if you don't follow 44 ADA, then you will have to maintain books of accounts compulsorily and you'll have to get them audited compulsorily. So below this, write down, without applying section 44 ADA, PGBP is only rupees 7,24,100, which is lesser than presumptive income, as per section 44 ADA. Therefore, it is advised not to opt for section 44 ADA. However, in that case, assessee shall mandatorily maintain books of accounts under section 44 AA and get them audited under section 44 AB. All right. I'll wait for a minute. Quickly finish this first working note, please. I hope we are done. Let's proceed. So PGBP, we will stick to 7,24,100. We will not choose 44 ADA. Capital gains, we've already finished the calculation. It is 1,60,000. Yes, I know you might be thinking, why is she writing the entire 1,60,000? Up to 1 lakh, it is exempt. But in computation of total income, you take the entire amount. Only when you calculate tax liability, you will say 1 lakh exempt, beyond that excess taxable. You understand? Capital gains, when you have section 112A capital gains, yes, up to 1 lakh it is exempt, only beyond that the excess is taxable. But in the computation of total income, you will take the entire amount. Only when you calculate the tax liability, only at that time you will consider the exemption. Okay, so this is it about capital gains. And then IFHP also we have done the calculation, 86,760. So fill that number as well, IFHP 86,760. And lastly, we have IFOs. IFO is only one number, 84,000. So add up, what is your gross total income? 7,24,100 plus 1,60,000 plus 86,760 plus 84,000. You get 10,54,860. Yes. Now, from this, we are supposed to subtract chapter 6A. Before I subtract chapter 6A, does any concept strike your mind again? Think something is supposed to do before subtracting chapter 6A. I am supposed to split this income into two parts, right? Normal rate income and special rate income. Why do I do that? Because chapter 6A deductions are allowed only against normal rate income. Isn't it? So what is my normal rate income? Everything else except 112A. Special rate income, I have 1,60,112A. The balance is normal rate income, 8,94,860. From this, I will subtract my chapter 6A deduction, which is there in working note number 3. Now, working note number 3, what is my total section ATC? It comes to 3,79,000. But I'll have to restrict this to how much? ATC is always restricted to 1,50,000. So what will my total chapter 6A be? It will be 1,50,000 of section ATC, right? Plus 1,21,000 of ATG plus 3,50,000 of ATGGC. This will give you 6,21,000. Okay, so come back to your main answer. Less chapter 6A, 6,21,000. We will subtract this only from a normal rate income. So what is a balanced normal rate income? You'll get 2,73,860. Your special rate income is 1,60,000. So what is our total income now? Total income is going to be 4,33,860. We'll call this a total income. I hope you have all gotten it right until here. Yes, done. Now we just have to do the tax liability calculation. I'll try to squeeze in the tax liability calculation here itself. Now, how to compute tax? First of all, what will my assessee's basic exemption limit be? See, how old is he? He's only 58 years old. He's not a senior citizen. So his basic exemption limit is going to be 2,50,000, right? And this entire 2,50,000 I will use of against normal rate income. So what is my normal rate income? What is my balance normal rate income? I had 2,73,860. I will adjust basic exemption limit against this. So I will be left with the balance 23,860. So what will be the tax on this normal rate income? Beyond 2,50,000 up to 5 lakh, what tax as per the slab rate? 5%. So 23,860 into 5%, you will get 1,193. This will be the tax on normal rate income. What about the tax on special rate income? We did not have any basic exemption limit left. Entire basic exemption limit we utilized against normal rate income. So my special rate income will be fully taxable as it is. I have special rate income of 1,60,000. Out of 1,60,000, 1 lakh is going to be exempt. Beyond 1 lakh, I have 60,000. On 60,000, I will calculate tax at 10%. So tax on my special rate income is going to be 6,000. How did I calculate this? 1,60,000 was my income. Out of this, 1 lakh is exempted. So balance, I'm left with 60,000 on that 10%. Right? So what is the total tax now? 7,193. From this, what do we subtract? From this, we subtract rebate under section 87A. First of all, tell me, is rebate applicable? For rebate to apply, we have some conditions to fulfill. Assessee should be a resident, assessee should be an individual, and total income should not be more than 5 lakhs. Yes, total income is not more than 5 lakh. Total income is only 4,33,860. Total income is within 5 lakh. Assessee is an individual, assuming he's a resident, so rebate is applicable. But what is the maximum rebate? 12,500. Now at this stage, you guys think and tell me what is the rebate amount which I should subtract. I'll give you two options. Should I subtract 7,193 or should I subtract 1,193? Rebate is applicable. How do I say rebate is applicable? I say rebate is applicable because individual total income is not more than 5 lakhs. So rebate is definitely applicable. Maximum rebate is 12,500. But how much rebate will I subtract over here? Only 1,193. Why only 1,193? What about the balance? I will subtract only 1,193 because rebate under 87A is not applicable to section 112. Do you guys remember? Yes, rebate under 87A is not applicable to 112A. That is why this tax on 112A income that I will not give as rebate, balance income alone, tax on balance income alone, I will allow as rebate. So this will be my balance tax. Obviously, no surcharge over here. I'll straight away add cess at 4%, which will be 240. Okay. So my total tax is going to be 6,240. Did we understand this? Any questions? If any of you have, please get it clarified right away. If no questions, we are good to go. Are we all done writing? No questions? 100% clarity? Yes, this was a pretty good question. A typical total income question. PGBP we remembered to apply 44 ADA. Capital gains 112A calculations we did. The rest of it was pretty fine. Right? I guess I'll go ahead now. I have a question in the chat box. The student is asking if we had some balance in BEL after normal rate, can we use that for special rate? Yes, you can. You can use that for 112A, 112, 111A incomes, but you cannot utilize that against lottery winnings. Even lottery winnings are special rate incomes. You cannot utilize unutilized BEL against lottery winnings. Against 112A and all, you can utilize. All right. So now we'll go to the next question. We'll go to question number 2. Question number 2 is another interesting question. It's a residential status question only, but the calculation is very different from the kind of calculations which you have done until now. Let's read the question. It says, determine the residential status and total income of Mr. Raghu for the assessment year 21-22 from the information given below. Mr. Raghu, aged 62 years. He is 62 years old, indicates he is a senior citizen. He is an American citizen. He is employed with a multinational company in Gurugram. Mr. Raghu holds a senior level position as researcher in the company since 2009. To share his knowledge and finding in research, company gave him an opportunity to travel to other group companies outside India while continuing to be based at the Gurugram office. The details of his travel outside India for the financial year 2021 are as under. USA, 25th August to 10th November, UK, Germany. During the last 4 years preceding the previous year 2021, he was present in India for 380 days. During the last 7 previous years preceding 2021, he was present in India for 700 days. During 2021, he earned the following incomes. What are they asking us to do? They're asking us to do 2 things. They're asking us to find his residential status, and they're also asking us to compute his total income. All right, 2 things, residential status and total income. Now, first, let us do the residential status discussion, and then we will go to the total income discussion. Okay, so we are working out question number 2. Residential status of Mr. Raghu for previous year 2021, assessment year 21-22. Now this assessee is an individual. When the assessee is an individual, you will always see whether special provision is applicable or not. We spoke about the special provision, regular provision and all even in the MCQ discussion. Now to apply the special provision, the assessee should be an Indian citizen or a person of Indian origin. He must be engaged in business or profession outside India. He must be coming on a visit to India in the previous year, and his total income minus income from foreign sources should be more than 15 lakhs. All these conditions should be fulfilled. Here, we get stuck with the first condition itself. Assessee is an American citizen. He is not an Indian citizen. And also the question does not tell us that he is a person of Indian origin. So at the first condition itself, it gets stuck. Hence, special provision not applicable. So we will apply our old provision, our regular provision itself. What does our old provision say? What is basic condition 1? Basic condition 1 is that in the previous year, my assessee should have stayed in India for at least 182 days. All right, in the previous year, assessee should have stayed in India for at least 182 days. Now, what is my previous year? Previous year 2021. So, in previous year 2021, what is my assessee's stay in India? We'll have to do the calculation. This is where the entire trick is in this question. Okay, see, the question says he's an American citizen. He is employed in Gurugram. He holds a senior level position. Company gave him opportunity to travel to other group companies outside India. And how many days is he outside India? It says he's outside India for these days. See, generally, when they give us dates, we include the date of arriving and we also include the date of leaving. This question plays on that concept. Now, when is he going to US? He is going to US from 25th August to 10th November. So, which means till August he is in India. So, April, full 30 days he is in India. In May also, all 31 days he is in India. Even in June, all the 30 days he is in India. Even in July, all 31 days he is in India. Now, when I talk about August, this is where you will realize what is different with this question. See, August, 25th August 2020 to 10th November, he is staying in USA. This is his period of stay. 25th August 2020 to 10th November, we are counting in USA. So when I count till when he was in India, I will stop till 24th August. Yes, the day of leaving and the day of arriving, I consider them both in India. But the question very clearly says over here that from 25th August to 10th November, count it as USA. So India, I will stop with 24 days. Are you seeing the difference? Are you able to identify what is different in this question? Here, they are telling us for how long has he stayed in USA. So 25th August to 10th November. 25th August also I will count as USA. 10th November also I will count as USA. Now after August, when is he coming to India again? Only in November. November, how long is he staying in India? See, he's staying in USA till 10th November. So only from 11th November, I will start counting. And he's leaving for UK. 20th November, I will count as if he is in UK. So he is in India from 11 to 19, both days included. 10th, I will count as USA. 20th, I will count as UK. So in November, he is in India from 11th to 19th, both days included. So 19 minus 11 plus 1. Why plus 1? Because both days included. 10th, I will count as USA. 20th, I will count as UK. So in between, we have from 11th to 19th, both days included. 19 minus 11 plus 1, here I will get 9 days. And then does he come back to India? From UK, he comes back to India in December. December, he's coming back to India on 23rd December. Generally, he's not, I cannot say he's coming back to India on 23rd December because the question says he's staying in UK till 23rd December. So even 23rd December will get counted in UK. So in India, from when to when? In India will be from 24th onwards. All right. Generally, even the date on which he arrives to India, we do count. But here the question is telling us that till 23rd December, he is outside India. He's in UK. So we will start counting only from 24th onwards. Okay. So here I will calculate like this. So total 31 days in December. He is coming to India on 24th and plus 1. Why plus 1? To include 24th also. From 24th onwards, 24, 25, 26. From 24th onwards, I will count in India. Okay, so 31 minus 24 plus 1, December, I will have 8 days. Is this clear? Are you all following? Till 10th November, count as USA. 11, 12, 13, 14, 15, 16, 17, 18, 19, India. 20 November and 23rd December, both count in UK. 24th December onwards, India. That is why 31 minus 24 plus 1. Then January, 10th January to 24th March counted in Germany. So in January, India only 9 days. 10th January also counted as Germany. So only 1 to 9, only 9 days in India. Then he's coming back straight away in March. March, when is he coming to India? He's coming to India on 24th March. No, I cannot say he's coming to India on 24th March. I can say he's coming to India only on 25th March, because 10th Jan to 24th March, I will count as stay in Germany. So I will consider as if he's coming to India on 25th March. So 31 days in March minus 25th, he's coming to India plus 1. So 31 minus 25 plus 1, 7 days in March. Basically, I will start counting from 25 onwards. 25, 26, 27, 28, 29, 30, 31. 7 days. Now add up. Totally, how many days has he stayed in India? Totally 179 days only he has stayed in India. This is the trickiest calculation, the trickiest part of this question. Are we all done writing? Did we understand also? Yes. So this is it about the first basic condition, definitely not fulfilled because he has not stayed in India for 182 days. This is less than 182 days. Therefore, basic condition 1 is not fulfilled. Then, what does basic condition 2 say? Basic condition 2 says, stay in previous year should be at least 60 days and stay in India in 4 preceding previous years put together should be at least 365 days. Isn't it? Now, this first part is definitely fulfilled because previous year assessee is staying 179 days. Basic condition 2 is just 60 days. That is definitely fulfilled. It also says 4 preceding previous years, assessee should have stayed in India for 365 days. Now, what does the question say? The question says, during last 4 years, preceding previous year 2021, which means 4 preceding previous years, he was in India for 380 days. For 380 days, therefore, even this condition is fulfilled. Basic condition 1 not fulfilled, basic condition 2 fulfilled. Hence, what will we conclude? We will conclude that our assessee is definitely a resident. See, normal provision before we apply basic condition 2, we do talk about those 3 scenarios. Is he an Indian citizen leaving India, crew member of Indian ship? No. Is he Indian citizen leaving India, employment outside India? No. Is he Indian citizen or person of India coming on a visit to India? No. So basic condition 2 is applicable and basic condition 2 is fulfilled. Hence, what will I conclude? My assessee is a resident. Once we conclude the assessee is a resident, we also check whether additional conditions are fulfilled or not, right? And we have 2 additional conditions. Additional condition number 1, assessee should be a resident in 2 out of 10 preceding previous years. And additional condition number 2, in the last 7 preceding previous years, assessee should have stayed in India for at least 730 days. But here, if you see, the question says 7 preceding previous years, assessee stayed in India for just 700 days. He has not stayed in India in 7 preceding previous years for 730 days. Only if both the additional conditions are fulfilled, we say assessee is ROR. Because one of the additional conditions is not fulfilled, we will say assessee is RNOR. All right. So assessee is resident, you understood. We applied regular provision. As per regular provision, first basic condition we couldn't fulfill, but second basic condition we were able to fulfill. So we concluded assessee is resident. Then below that write down, however, assessee has not stayed in India for at least 730 days in 7 preceding previous years. Therefore, an additional condition is not fulfilled. Hence, assessee is RNOR. Even if one of the two additional conditions is not fulfilled, we conclude assessee is RNOR. You know this, right? We have two additional conditions. Even if one of the two additional conditions is not fulfilled, we conclude assessee is RNOR. Here, an additional condition is not fulfilled, hence RNOR. Now, for RNORs, which income is taxable? Incomes which are earned in India, incomes which are received in India, and incomes from businesses which are controlled in India, isn't it? Now, if you look at the incomes over here, they asked us to not only find residential status, they also asked us to find his total income. And they're talking about three incomes over here. First of all, they're talking about salary income. He's RNOR, remember. So what is his salary income? Salary is 15 lakh 80. Salary is paid by Indian company in his Indian bank account, which means the salary is received in India. It is received in his Indian bank account. Received in India, hence taxable. His salary is 15 lakh 80,000. From this, remember to subtract standard deduction of 50,000. Why? Because the question does not say this is computed salary. The question just says this is salary income. Only if they mention in brackets it is computed, only then it will indicate that standard deduction, everything already provided. They are just mentioning salary, which means it is not computed salary. So what will a salary income be? 15 lakh and 30,000. Okay, his salary income is going to be 15 lakh and 30,000 after subtracting standard deduction. Taxable. Why? Because it is received in India. Then dividend. He's also having dividend income. Dividend amounting to 48,000 received from Treat Limited, received from a Singapore-based company. So where is the source of this income? Singapore, not in India. It was transferred to his bank account. Transferred means what? It was remitted to his bank account. The source is in Singapore. He would have even received it there, and then he has transferred to Indian account. We know very well transfer and remittance should be ignored. Nothing to do with this. And lastly, FD interest from Punjab National Bank, Delhi. So source of this interest income will be in India. So FD interest how much? 10,500. FD interest 10,500. So what is his GTI now? His GTI will be 15 lakhs 40,500. Now if you see, assessee is a senior citizen. And for senior citizens, you get Section 80 TTB benefit, FD interest, maximum 50,000 allowed as a deduction. Here only 10,500. So 15 lakh 30,000. This will be your assessee's total income. Are we clear? Did you understand? Salary income, I subtracted 50,000 because standard deduction. Dividend income we did not consider because it is only remitted to India. Source outside India, received outside India. Remittances and transfers we don't bother. FD interest we taxed because this source is in India. It's received from an Indian bank. And FD interest, as I see senior citizen, so FD interest you will get 80TTB benefit. This is it with question number 2. I'll pause for a minute in case anybody is still writing any part of this solution. Please finish it and then we will go to the next question. Going ahead, hoping you all are done. The next question, question number 2B, simple question. Determine the advance tax payable by Mr. Deepak with their due dates for the assessment year 21-22. We just have to say how much advance tax is to be paid and when. Total estimated tax payable is 5,50,000. TDS, deductible but not deducted. If it is not deducted, nothing to do about it. Ignore it. If it is not deducted by the person who gave us the income, we don't have the credit of it. So we have to pay this number. It was deductible, but it was not deducted, which means assessee has to pay it now. And TCS collected was 20,000. All right. So let's do the calculation. Answer to question number to be. So what is the tax liability of the assessee? The tax liability is 5,50,000. From this, we will subtract TCS. Why will we subtract? Because somebody has already collected so much tax from us and they would have paid it to the government. So we don't have to pay this much tax again. TDS we are not subtracting because it was deductible, but it was not deducted by that person. It was not deducted by that person. That person gave us the entire income without deducting. So we have to pay it now. So what is the tax liability of the assessee? 5,30,000. This 5,30,000, this is what you will have to pay as advance tax. All right. Now, how many installments? 4 installments. Each quarter, one installment. So what are our 4 installments? June 15, then September 15, then December 15, and then March 15. On June 15, first installment, we should pay how much? What is the percentage? 15%. So 5,30,000 into 15%. How much does this work out to? First installment, we will pay 79,500 advance tax. In my second installment, we should pay how much advance tax? 45%, right? So, but from this number, we will subtract 79,500 because we have already paid it. So 5,30,000 into 45% is 2,91,500. But we have already paid 79,500. So we will subtract that. Balance 1,59,000 assessee will pay in September 15. Then December 15, third installment, assessee should pay 75%. From this, we will subtract 79,500 and 1,59,000 because that much assessee has already paid. So 5,30,000 into 75% is 3,97,500. From that, we will subtract 79,500. We'll subtract 1,59,000 because already paid by the assessee. So balance 1,59,000 assessee will pay now. And last installment, 5,30,000 into 100%. From this, we will subtract 79,500, 1,59,000 and another 1,59,000 because all these amounts assessee has already paid. So 5,30,000 minus 79,500 minus 1,59,000 minus 1,59,000, you will get 1,32,500. Very simple question. Right? So these are the 4 advance tax installments that will be paid by my assessee. 15%, 45%, 75%, and finally 100%. Each quarter, 1 installment. Can I go to the next question? I hope we are all done writing. Okay. Proceeding to this to question number C, subdivision C of question 2. Mr. Praveen, due to inadvertent reasons, failed to file his income tax return for assessment year 21-22 on or before the due date of filing return of income. He did not file his return of income within the due date. Can he file the above return after due date? Which means you're asking us, can he file a late return? Can he file a belated return? What is the last date for filing the above return? If you don't file your return on time, yes, you can file a belated return. You can file a late return. The last date for that will be the last date of the assessment year. Assessment year 21-22 we are talking about. So the last date will be 31st March 2022. Okay, so in case my assessee does not file the return of income on time, yes, he can file a belated return. For belated return, the last date would be the end of the assessment year. What are the consequences of not filing the return within due date? When you don't file the return within 139 subsection 1 due date, you do have some consequences. For example, you will not be able to carry forward the losses which are incurred in the current year. Second, section 234A interest assessee will have to pay at the rate of 1% per month. Also, section 234F fees assessee will have to pay. Now, what will this fee be? The fee will depend upon the total income of the assessee. If the total income of the assessee is within 5 lakhs, if it is less than or equal to 5 lakhs, then we will ask the assessee to pay 1000 rupees as fees. If the total income is more than 5 lakhs, and if the assessee is filing a late return, but if he is filing the return before 31st December of the assessment year, then we will ask the assessee to pay 5000 rupees as fees. But if he is filing the return only after 31st December of the assessment year, then we will ask him to pay 10,000 rupees as fees. Right? So in case my assessee makes a late filing, in case my assessee makes a belated return, then what are the implications? What are the consequences of not filing the return within 139(1) due date? Number one, losses which you incurred in the current year, sorry, you will not be able to carry them forward. But we have some exceptions. Remember, house property loss, it's okay. Even though you did not file income tax return on time, you can still carry forward. Even your unabsorbed depreciation doesn't matter. Even though you did not file the return on time, you can still carry forward. But all other losses which you incurred in the current year, you cannot carry forward because you did not file the return on time. Then section 234A interest at the rate of 1% per month assessee will have to pay. 234F fees depends upon what is the total income. Total income is not more than 5 lakhs. Assessee will have to pay 1000 rupees fees. Total income is more than 5 lakhs, but assessee filed the return late, but within 31st December, then 5000 rupees. He filed the return late after 31st December, then 10,000 rupees fees. All right, this is it with question number 2. So with this, we are done working out question number 1, the big total income question. Then we worked out question number 2, which had a question on residential status, another question on advance tax, and now about late filing of income tax return. All right, shall we go to the next question now, the third question? The third question is an IFHP question, and many of us would have already worked out this question. This is a very popular examination question. It's also there in the study material. If I'm not wrong, we also work out this question in our usual classes, isn't it? So the students who are watching this lecture right now, if you have attended my classes, we would have already worked out this question in class. But nevertheless, we'll anyways work it out again. It is a part of the mock test paper, and we are solving it, so we might as well work it out again. Question number 3, subdivision A. IFHP based question. Mr. Naveen and Mr. Vikas constructed their houses on a piece of land purchased by them at Delhi. Built up area of each house was 1800 square feet, ground floor, and an equal area in the first floor. So both Mr. Naveen and Mr. Vikas, both of them have constructed a house each. Both their houses has a ground floor and a first floor. Naveen started construction on 1st April 2018 and completed it on 1st April 2020. Vikas started the construction on 1st April 2018 and completed the construction on 30th September 2020. Naveen occupied the entire house. So Naveen has self-occupied the entire house. Vikas occupied the ground floor self-occupied, and he let out the first floor for a rent of 20,000 per month. However, the tenant vacated the house on 31st December 2020 and Vikas occupied the entire house during the period Jan to March. So what has Vikas done with the first floor? Part of the year let out, part of the year self-occupied. Now tell me, what is a provision? If the house property is let out for a part of the year and self-occupied for the remaining part of the year, what do you do? Come on, think and tell me. Let out for a part of the year, self-occupied for another part of the year. How do you calculate? What do you do in such case? You treat as if it is let out for the entire year. Remember? Yes, self-occupied for a part of the year, let out for another part of the year, treat as if it is let out for the entire year. Then, following are the other information: parent, municipal value, municipal tax, repair and maintenance charges. Okay. Naveen has availed a housing loan of 15 lakhs at 12% per annum on 1st April 2018. Vikas availed a housing loan 10 lakhs on 1st July 2018. No repayment was made by either of them till 31st March 2021. Compute IFHP for Naveen and Vikas. For both of them, we have to compute IFHP. Naveen, it's going to be very simple. Full house self-occupied. Vikas, some complication. Two separate calculations. Ground floor self-occupied and first floor let out. Two separate calculations we will have to do for Vikas. Shall we get to work? Is the question clear? Come on, let's begin. First, let's do the calculation for Mr. Naveen. So give the heading Mr. Naveen. In brackets, write on self-occupied. We're doing the calculation for previous year 2021. All right, remember our calculation is for previous year 2021, or you can see assessment year 21-22. Now self-occupied house property. How do we start? How do we begin the calculation? We will start with NAV. NAV is always 0. We will subtract deductions under section 24. Only one deduction we will have, and that is interest on borrowed capital. Interest on borrowed capital, give reference to working note number 1. Leave some 2 or 3 lines gap and then give the heading working note number 1. Interest on borrowed capital, Mr. Naveen. All right. Now listen, look at this question. Look at Mr. Naveen's information. He completed the construction on 1st April 2020. But when did he borrow the loan? Naveen borrowed the loan on 1st April 2018. But he completed the construction on 1st April 2020. He borrowed the loan in 2018. He completed the construction on 1st April 2020. Does any concept strike your mind? Think and tell me. Anybody? Any concept over here? He has completed the house on 1st April 2020, but before that itself, on 1st April 2018 itself, he borrowed a loan. So definitely he's going to have pre-construction interest in this question. We have pre-construction interest as well as current year interest. So under this, write down point number A, pre-construction interest. Pre-construction interest is the only complicated part under IFHP chapter. But even this is very simple if you follow the 6 steps which I'm going to show you. Students generally, they get confused over here very badly. And I always tell them to follow these 6 steps and they are always comfortable thereafter. So all of you, I urge you all to follow these steps. Step number 1. What is the date of completion of construction? You can follow these 6 steps blindly in every question wherever there is pre-construction interest. All right. This will simplify the concept of pre-construction interest for you all to a great extent. Trust me. What is the date of completion of construction? When did Mr. Naveen complete the construction? 1st April 2020. Then step number 2. Step 2 will be 31st March preceding step 1, which means what? Just before step 1, when was the last 31st March? Tell me. Just before step 1, when was the last 31st March? Just before 1st April 2020. The last 31st March was 31st March 2020. Then step 3. Step 3 will be your pre-construction period. Pre-construction period. Now, what is a pre-construction period in this question? When did my assessee borrow the loan? He borrowed the loan on 1st April 2018. Pre-construction period will always end on step 2 date. What is the step 2 date? 31st March 2020. Step 1, date of completion of construction. Step 2, just before step 1 date. When was the last 31st March? Step 3, pre-construction period starting on when you borrowed the loan and ending on the step 2 date. Then step 4. Step 4 will be the pre-construction interest. Pre-construction interest is nothing but for this period, how much interest have you paid? How much loan did Mr. Naveen borrow? He borrowed a loan of 15 lakh rupees. So 15 lakh rupees into, at what rate did he borrow? 12% he borrowed. And what is the period? 1st April 2018 to 31st March 2020. This is going to be 2 years, right? So for 2 years, we have to calculate this interest. What will the amount be? Do the math. 15 lakh into 12% into 2 years. You will get 3,60,000 rupees. Do we all get this right? Yes. All right. After this, step 5. We all know pre-construction interest will be allowed as a deduction across how many years? Across 5 years. So divided by 5 years, nothing but 3,60,000 divided by 5. What is the amount that you get for each year? Each year you will get 72,000. Right? So 15 lakh into 12% into 2. This is the total pre-construction interest. 72,000 for 5 years you will get as a deduction. Step 6. For which years will you get as a deduction? You will start with the year of completion of construction. When did the construction get completed? In previous year 2021. That year onwards, 5 years. So previous year 2021, previous year 21-22, then previous year 22-23, previous year 23-24, and previous year 24-25. For these 5 years, you will get the deduction of 72,000 each year. Now, what is your current previous year? We are doing the calculation for 2021. Is 2021 in this list? Yes. So we will get pre-construction interest of 72,000 in the current year. Okay. Are we clear? These are the 6 steps I was talking about. Step 1, date of completion of construction. Step 2, just before that, when was the 31st March? Step 3, pre-construction period, starting from the date of loan and ending on the step 2 date. Then step 4, for that period, what is the interest? Step 5, pre-construction interest divided by 5. And step 6, give the list of the 5 years when you will get this deduction. The 5 years will start from the year in which you completed the construction. Okay, so this is my pre-construction interest. Then number B, we'll also have current year interest. Current year, the entire 15 lakh loan is outstanding. We'll have to pay 12% interest for the current year. So what will our current year interest be? 1,80,000. So what will the total interest deduction be? We'll have pre-construction interest of 72,000. We'll have current year interest of 1,80,000. So the total interest becomes 2,52,000. But for self-occupied property, we have a limit. If the loan is if the loan is borrowed for purchase or construction of a property, and if the construction is completed within 5 years from the end of the previous year in which loan is borrowed, and if the loan is borrowed on or after 1st April 1999, then the maximum deduction you can get for self-occupied property interest will be 2 lakh only. In this question, if you see, all the conditions are fulfilled. Hence, you will get the deduction of 2 lakhs only. What are the 3 conditions? Number 1, loan is borrowed on or after 1st April 1999. Number 2, loan is borrowed for purchase or construction of property. Number 3, purchase or construction should be completed within 5 years from the end of the previous year in which loan is borrowed. Now, if you look at this question, when was the loan borrowed? 1st April 2018. 1st April 2018 means it is which previous year? Previous year 18-19. What is the end of previous year 18-19? 31st March 2019. From 31st March 2019, if you add 5 years, 31st March 2024. So on or before 31st March 2024, you must finish the construction. Okay, now when did we finish construction? On 1st April 2020, which is well within this period, 31st March 2024. So you will see the previous year in which the construction got completed. From the end of that previous year, within 5 years, you will see the end of the previous year in which loan was borrowed. From that date, within 5 years, loan was borrowed in 18-19. End of 18-19 is 31st March 2019. From that day, within 5 years, we must finish the purchase or construction. All 3 conditions fulfilled. Hence, this will be restricted to rupees 2 lakhs. Even if one of these conditions was not fulfilled, then we would have restricted the interest to 30,000. But here all the 3 conditions fulfilled, hence we will restrict it to rupees 2 lakhs. Otherwise, we would have restricted it to 50,000. So come back to your main answer. Interest on borrowed capital, 2 lakh is what you will subtract. So what is the net number now? We'll have a loss from house property for Mr. Naveen, and that is 2 lakh. So with this, the solution for Mr. Naveen is over. All right, I'll pause for a minute. In case any of you is still writing, Please finish the writing and then we will proceed. I hope you're all done writing. Can we start doing the calculations for Mr. Vikas now? Yes. So we had two assessees, right? Mr. Naveen and Mr. Vikas. We're done with Mr. Naveen. Let's start with Mr. Vikas. Here we will have two calculations, one calculation for the self-occupied unit and one calculation for the let-out unit. Okay, so let's begin. Write down Mr. Vikas. Let us finish the self-occupied unit first. Okay, the self-occupied unit. Now under this write down, we'll start with the net annual value. And the net annual value for self-occupied unit will always be 0, right? From this, we will subtract deductions under section 24. We'll have only one deduction and that will be interest on borrowed capital. Give reference to working note number 2. Leave 2 lines gap. Open working note number 2. Give the heading interest on borrowed capital. Interest on borrowed capital. For Vikas. Now, even for Mr. Vikas, if you see, he has borrowed the loan on 1st July 2018. Okay. Vikas has availed a housing loan of 10 lakh rupees on 1st July 2018. But when did he complete the construction? He completed the construction on Vikas started the construction, completed the construction on 30th September 2020. He borrowed a loan on 1st July 2018 and he completed the construction only in 2020. So here again, he will have pre-construction interest. So under this write down point A, pre-construction interest. The same 6 steps we will follow, guys. Okay. What is step 1? Date of completion of construction. When did Mr. Vikas complete the construction? 30th September 2020. What is step 2? 31st March. 31st March preceding step 1. Tell me, just before 30th September 2020, what is the last preceding 31st March? 31st March 2020. Then step 3. Step 3 will be our pre-construction period. Pre-construction period starts when? On the date of the loan. When did we borrow the loan? Vikas borrowed the loan on 1st July 2018. And when will we end the period? I told you on the step 2 date, that is 31st March 2020. Then step 4 will be our pre-construction interest. Nothing but for this pre-construction period, what is the interest? This period is how long? In 2018-19, you will have 9 months. In 2019-20, you have 12 months. So total this period is for 21 months. So my pre-construction interest will be like this. He borrowed 10 lakhs loan at 10% per annum. So 10 lakh loan, 10% rate of interest for 21 months. Why 21 months? Because 1st July 2018 to 31st March 2020, this period is 21 months. In step 4, we calculate interest for this period. So 21 months. How much will this be? 10 lakh into 10% into 21 by 12. You will get 1,75,000. What is step 5? Step 5 is nothing but step 4 divided by 5. So 1,75,000 divided by 5. How much do you get? 35,000. So we will get 35,000 deduction each year for 5 years. For which 5 years? I told you we will start with the year of completion. Year of completion is 2021. So previous year 2021, previous year 21-22, previous year 22-23, previous year 23-24, and previous year 24-25. For these 5 years only, you will get a deduction 35,000 each year. And what is our current previous year? Current previous year is 2021, which is within this list. So in my current previous year, I will get pre-construction interest of 35,000. Then point number B. What is our current year interest? Current year entire 10 lakh is outstanding. So 10 lakh into 10%, the entire 1 lakh will be current year's interest. So what is our total interest? Our total interest will be pre-construction interest of 35,000, current year interest of 1 lakh, total 1,35,000. But this 1,35,000, we will split between ground floor and first floor. Ground floor, which is self-occupied, and first floor, which is let out. So we will get 67,500 deduction for ground floor and 67,500 deduction for let out. Is this clear? Did we understand this? Yes. So this is the deduction that you will get. We split it like this because we're doing two separate calculations for Mr. Vikas. So for the self-occupied property, the interest we just calculated 67,500. For self-occupied property, do we need to restrict it? The limit will be 2 lakh if the loan is borrowed on or after 1st April 1999. Loan is borrowed for purchase or construction, and construction should be completed within 5 years from the end of the previous year in which loan is borrowed. All conditions fulfilled, hence the limit will be 2 lakh, and this is well within 2 lakhs. So the entire 67,500 I will get as a deduction. So what will our loss from house property be for Mr. Vikas? 67,500. All right. So this is it about Mr. Vikas's self-occupied unit. But the same Mr. Vikas also has a let out portion. So for that, we will begin the calculation. So write down Mr. Vikas let out property. For let out property, we start the calculation. Why let out, by the way? Part of the year it is self-occupied, part of the year it is let out. Do you see what is given over here? Vikas occupied the ground floor on 1st October 2020 and let out the first floor for a rent of 20,000 per month. However, the tenant vacated the house on 31st December 2020 and Vikas occupied the entire house during 1st Jan 2021 to 31st March 2021. So the house was self-occupied for a part of the year. The first floor was self-occupied for one part of the year, let out for one part of the year. We treat as if it is let out for the entire year. So write down under Mr. Vikas, the first floor is self-occupied for a part of the year and let out for the remaining part. Hence, it will be treated as if it is let out. It will be treated as if it is let out for the entire year. It will be treated as if it is let out for the entire year. Okay. Now, let out property, how do we calculate? The GAV and all we need to calculate. So first of all, write down gross annual value. Gross annual value, when you calculate, treat as if it is let out for the entire year. Actual rent alone you will take for the actually let out period. Okay. So what is the step 1 for GAV? Step 1 is municipal value or fair rent, whichever is higher. Now, when did the house get completed? Only on 30th September 2020, which means the house as such, it existed only from 1st October 2020 onwards, only for 6 months. So all our calculations will be for 6 months because the house as such is existing only for 6 months. So what is the municipal value? Municipal value 72,000 for ground floor separately, first floor separately. Fine, we need only first floor 72,000. But per annum, we need only for 6 months. Why 6 months? Because the house was completed only on 30th September. So the house existed only for 6 months. So what will your number be? 36,000. What is our fair rent? Fair rent for each floor is 1 lakh rupees per annum. But we will need only for 6 months. That is 50,000. Out of these two numbers, we pick whichever is higher. And that is 50,000. Then, what is step 2? Step 2 will be a step 1 number, which is 50,000 or standard rent. Now, in the question, have they given a standard rent? No. So, not applicable. So, out of these two, we are supposed to pick whichever is lower. Standard rent is not applicable. So, we will stick to 50,000 itself. Then, what is step 3? Step 3 is actual rent. See, everything else we calculate for the entire period. But actual rent alone we will calculate only for the actually let out period. What is the actually let out period? October, November, December. October only house is ready. October we gave it on rent. Tenant vacated on 31st December. So only for 3 months it is let out. So actual rent you calculate only for the actually let out period. That is October, November, December, 3 months. 3 months, 20,000 rent per month. So 20,000 into 3 and this is 60,000. All right. Now what is step 4? Step 4 will be step 2, which is 50,000, or step 3, my actual rent, which is 60,000. Out of these two, we will pick whichever is higher. And which is higher? 60,000. Okay. Then step 5, vacancy loss. No, my house has not been vacant at all. Till September, it was not even ready. Then once it was ready, October, November, December, it was let out. Jan, Feb, March, it was self-occupied. It was not vacant. So vacancy loss 0. Step 6 will be our GAV, nothing but step 4 minus step 5. So this is going to be 60,000. Okay. So below this, write down GAV 60,000. From this, we subtract municipal taxes paid. How much municipal tax did Mr. Vikas pay? Vikas has paid 8,000. Now this 8,000 will be for the entire house, ground floor and first floor put together. But we are calculating only for the first floor right now. So we will take only half of it, only for first floor, 4,000. So what is the net annual value? 56,000. From this, we will subtract deductions under section 24. We have two deductions. Number 1, we will have a standard deduction. Show the calculation. 56,000 into 30%, which will be how much? 16,800. Then we will have interest on borrowed capital. Give reference to working note number 2. We have already calculated. How much did we calculate for the let out property? 67,500. That is all. What is the net number you get? You get a loss of 28,300. Right? So if you look at the net number, if I have to give you the summary, for Mr. Naveen, we had a loss from house property of 2 lakhs. Isn't it? And for Mr. Vikas, we have 2 losses. We have 67,500 from the ground floor, and we have 28,300 from the first floor. So Vikas' total loss is 95,800. This is what your answer will be. Are we all following? I'll wait for a minute. In case anybody is still writing, please finish. And then we will proceed. I hope you're all done, all comfortable with this question. Yes. Can we go to the next question now? This was question number 3A. There's another question, 3B, which is a salaries related question. Shall we begin? I hope all of you are done with this question. Come on. This is going to be a simple question. This point onwards, we have some 2 or 3 questions left. They will be easy. There will be one tricky adjustment in this question, but not very complicated. I think we will be able to handle easily. Let's begin. Mr. Samaksh is a marketing manager in Smile Limited. From the following information, you are required to compute his income chargeable under the head salary. They are asking his salary income. So let's start. Let's make our table. Let's keep the answer format ready. As we read the question, we'll keep filling in the points then and there. So write down computation of salary income of Mr. Samaksh. We are doing this calculation for previous year 2021, in brackets write down assessment year 21-22. Okay, under this make a 3 columnar table. We'll have a broad particulars column. Then we'll have a working note column. And then we'll have an amount column. Okay, now under particulars, let's start reading. As we come across adjustments, let's keep writing down. First of all, my assessee has basic salary 70,000 per month. So under particulars, basic salary, show the calculation 70,000 per month for 12 months. So we'll have 8,40,000. Then DA is 40% of basic salary. DA, show the calculation again, 8,40,000 into 40%. 40% of basic salary. So how much do you get? 3,36,000. Then he is provided health insurance scheme approved by IRDA, for which 20,000 is incurred by Smile Limited. We all know medical insurance premium paid by employer for the employee is no doubt a benefit for the employee, but it is fully exempt. So under particulars, write down health insurance premium for employee paid by employer exempt. All right, remember this medical insurance premium, Mediclaim health insurance premium, which the employer pays for the health of the employee or his family members, is always exempt. Then received 10,000 rupees as gift voucher. Gift voucher will always be treated as gift in kind. Gift in kind up to 5,000 is exempt. If it is more than 5,000, there are 2 views. View number 1, more than 5,000, entire amount will be taxable. View number 2, more than 5,000, only the excess will be taxable. So it depends on you. You can do it either way. Answer will be different, but both answers will be correct. View number 1, if it is more than 5,000, tax the entire amount. View number 2, if it is within 5,000, if it is more than 5,000, tax only the excess. Okay, so here gift voucher. Gift voucher is nothing but gift in kind. Had it been a cash gift, 5,000 don't even bother. Had it been a cash gift, fully taxable. If it is gift in kind, you get 5,000 exemption. But here it is 10,000. Let's say I tax the entire 10,000. If you want, you can tax just the excess also. Even that will be fine. Then Smile Limited, who is Smile Limited? The employer. Smile Limited allotted 800 sweat equity shares in August 2020. Shares were allotted at 450 rupees per share. FMV on the date of exercising the option was 700 per share. So here under particulars, write down sweat equity shares. How many shares did Samaksh buy? 800 shares. How do we find the taxable value of the perquisite? You see what is the FMV on the date of exercise of option. FMV on the date of exercise of option is 700 rupees per share. From this you subtract how much did the employee pay. Employee paid 450 rupees per share. The balance will be taxable. So 700 minus 450 into 800. 2 lakh rupees. This will be the taxable value of the perquisite, right? Whatever is the FMV on the date of exercise of option, from that we will subtract the amount which is already paid by my assessee, and the balance is going to be taxable. So 2 lakh is a taxable number we get. 700 minus 450 into 800 shares. Then he was provided with furniture during September 2016. Furniture is used at his residence for personal purposes. Use of movable asset, perquisite. Actual cost of the furniture was 1,10,000 on 31st March 20. So till here, if you see, assessee is using furniture belonging to the employer. So nothing but use of movable asset. Use of movable asset, what is the tax treatment? If it is laptop, it is exempt. Other assets, 10% of cost is taxable. Or if the employer has taken it on rent, higher charges are taxable. Here the employer owns it. So 1,10,000 into 10%, which is 11,000, that will be taxable. Use of movable assets, use of furniture, 10% of actual cost is taxable. Then on 31st March 2021, end of the previous year, company offered the furniture to him at free of cost. What is happening now? Now the employer is selling away the furniture to my assessee. Are you able to understand? Until now, from September 2016 until 31st March 2021, the furniture was with the employee only. But employee was just using it. It was owned by the employer. But now on 31st March 2021, end of the previous year, the employer is transferring the furniture to the employee. So transfer of furniture, we'll have to do the calculation. Give reference to working note number 1. Leave some 7 to 8 lines gap. Begin working note number 1. Give the heading transfer of furniture. I hope you all know the steps. We start with the actual cost. What was the actual cost of the furniture to the employer? 1,10,000. From this we subtract normal wear and tear. How to find normal wear and tear? Had it been computer or other electronic gadgets, 50% per annum WDV we would have calculated. If it was motor car, 20% per annum WDV we would have calculated. This is neither motor car, this is neither computer, it is furniture. For all other assets, you have 10% SLM. Now this wear and tear has to be calculated only for completed years. Basically, for the years for which the employer has used the asset, or the years for which the employer has owned the asset for his official purposes, only for those years you will calculate. Now, when did the employer purchase it? In September 2016. So September 2016 to when did he transfer it? 31st March 2021. Now, how many completed years do we have? September 2016 to September 2017, 1 year. September 2017 to September 2018, second year. September 2018 to September 2019, third year. September 2019 to September 2020, fourth year. September 2020 to March 2021, only a fraction of the year. I will ignore the fraction. I have 4 completed years. For these 4 completed years alone, we calculate wear and tear. Are we all clear with this? Do you understand? Yes, we will calculate normal wear and tear only for the completed years. We will calculate wear and tear only for completed years. Any fraction we will ignore. So 1,10,000, 10% wear and tear, SLM. So every year it will be the same number for 4 years. How much do you get? 44,000 will be your wear and tear. Is every single student clear with this? Understood, guys? Yes, so normal wear and tear is calculated only for completed years. Any fraction we will ignore. So September 2016 to September 2020, 4 completed years, SLM basis 10% per annum. SLM means every year same amount. So straight away I multiplied by 4 years. From this we will subtract sale consideration paid by employee. Tell me, did the employee pay any amount for this furniture? No. The question says company offered the furniture to him at free of cost. So sale consideration paid by employee is 0. What is the balance? The balance will be the taxable value of perquisite. What is the balance, guys? You get 66,000. This will be the taxable value. Got it? So now going back to our answer, transfer of furniture, 66,000. This is what your answer would be. Okay. So this adjustment also we are done. Then he received 10,000 towards entertainment allowance. Entertainment allowance is fully taxable. You get a deduction only if you are a government employee. But your assessee is not a government employee. It will be fully taxed, no deduction. Then housing loan at 4.5% per annum is provided by Smile Limited. Amount outstanding on 1st April 2020 is 12 lakhs. 50,000 is paid by Mr. Samaksh every quarter towards principal starting from June 2020. Lending rate of SBI for similar loan on 1st April 2020 was 8%. What is this adjustment all about? What is this adjustment talking about? It is nothing but loan at concessional rate. Isn't it? Loan at concessional rate. We will see what is the SBI lending rate on the first day of the previous year. 1 minute, guys. I just hurt myself. Just 1 moment. All right. So we will see what is the SBI lending rate on the first day of the previous year. That is 8%. And at what rate is my employer giving me the loan? At just 4.5%, which means he's giving me a loan at concessional rate. What is the concession I am enjoying? Can you tell me? I'll give you options. Is the concession 4.5%? Is the concession 8%? Or is the concession 3.5%? What would you say? The SBI lending rate is 8%. Employer is giving us a loan at 4.5%. So what is the concession? What is the benefit that the employee is enjoying? The employee is enjoying the benefit of the difference of 3.5%. Okay, so 3.5%, this is going to be our benefit. This is going to be our concession. The loan is more than 20,000 and the purpose is not medical purposes. Therefore, it is definitely going to be taxable. All right. Every quarter starting from June 2020, he is repaying 50,000. So under particulars, write down loan at concessional rate. Give reference to working note number 2. After your first working note, open another working note. Working note number 2. Give the heading loan at concessional rate. Okay. Now over here, we have to do the calculation month-wise. Month or period, whatever you want to write. Then write down maximum outstanding balance at the end of the period. And then last column, taxable value. Taxable value we will calculate at 3.5%. We just discussed, right? The benefit which my assessee is enjoying is 3.5%. See, he starts making the payment only from June. So April and May, there will be no change. April and May, the entire loan will be outstanding. What is the loan amount? The loan amount is rupees 12 lakhs. Entire 12 lakh is outstanding. So 12 lakhs will be outstanding. Now, how to calculate the taxable value of perquisite? 12 lakhs into 3.5% into, for how many months are we calculating? Only for April and May. So 2 by 12. Are you understanding? You will basically see what is the amount outstanding at the end of that period. April and May, we did not repay anything. So full 12 lakh is outstanding. 12 lakhs is the amount of the loan. Full 12 lakh is outstanding. So 12 lakh into 3.5% into 2 by 12. So how much will this be? 7,000, right? So April to May, 7,000. Now in the month of June, he is going to repay 50,000. So he's going to pay 50,000 every quarter. Every quarter means he will pay in June, then he will pay in September, then he will pay in December, and then he will pay in March. So once he pays in June, he'll pay off 50,000. So if he pays off 50,000, 11 lakh 50,000 will be outstanding. Till August, 11 lakh 50,000 will be outstanding. The next payment will happen only in September. So June to August. In June, he's paying off 50,000. So June outstanding will be 11 lakh 50. In July, no payment. August, no payment. So June, July, August, the outstanding balance will be 11 lakh 50. So on this 11 lakh 50, what is the interest? For how many months? June, July, August, for 3 months. How much do you get? You will get 10,062.5. Okay. Then in September, he's making a payment of 50,000. So September, he makes the payment and it will be reduced to 11 lakhs. This 11 lakhs only, it will remain till when? Till December. December only he is making the payment again. So September to November, it's going to remain 11 lakh. September, he pays off 50,000. So September also 11 lakh only due. October also 11 lakh only due. November also 11 lakh only due. Next payment will be made only in December. So on this 11 lakh, we will calculate 3.5% interest for 3 months, September, October, November. So how much do you get? You will get 9,625. Then December again he pays off 50,000, 10 lakh 50,000 will be outstanding now. December, Jan, Feb, 10 lakh 50 only will be outstanding. Next payment will happen only in March. So December to February, 10,50,000 will be outstanding. 10,50,000 into 3.5% into 3 by 12. How much will this be? You will get 9,187.5. Please check my math. I hope it is right. And then lastly, in the month of March, he pays another 50,000. So in the month of March, 10 lakh only will be outstanding. So 10 lakh into 3.5% into, only for 1 month we are calculating now. 10 lakh into 3.5% divided by 12, 2,916.67. So what is the total number? You will get 38,792. This will be the taxable value of the perquisite. Are we all getting it right? Yes. June he makes the payment. September he makes a payment. December he makes a payment, and March he makes a payment. So whenever he makes a payment, I start a new period. June to August, 11,50,000 will be outstanding. September he pays off 50,000. So September onwards, only 11 lakh outstanding. December he makes another payment. March he makes another payment. So what's the total taxable value over here? 38,792. I hope they're all clear with this. Okay. Then after this, what is our next adjustment? Laptop. Laptop facility we know is always exempt. When the employer gives the employee a laptop or computer just for use, it will be considered as exempt. So now at this stage, what is our gross salary? Add up. 15,11,792, right? From this, we will have deductions under section 16. No entertainment deduction, no professional tax deduction over here. Only one deduction we have, and that is standard deduction. So standard deduction, how much will we get? 50,000. So what is our net number? 14,61,792. We will call this as net salary. $14,61,792. This is what our answer is going to be. I'll wait for a minute. Those of you who are still working it out, please finish this. Guys, it is pretty late. So those of you who want to sleep, you all can go ahead. Because my target is I somehow have to finish off the mock test paper tonight. That was my plan for today. So I don't want to go to sleep without ticking that, but I'm done with it. I want to tick that. I want that pleasure of, ticking it, that yes, I'm done with the mock test paper. So I'm going to stay up and finish it. There are 2 more questions. So in case you guys are tired, in case you're not able to stay up, you all can go to sleep, no problem. The session will anyways be there as a recorded session. It will stay on my channel. So you all can watch it even tomorrow. So no problem. It will take us another 20 minutes, I guess. The remaining 2 questions are small only. It will take us another 20 minutes. So if you all are energetic enough to stay up a little more, then great. But those of you who are early risers, those of you who are way too tired and sleepy, you all can close the session for today. It's perfectly fine. All right, the session will anyways be there. The remaining 2 questions you all can work out even tomorrow. All right, I'll go ahead with the remaining 2 questions now. So now coming to the 4th question, 4A. This question was pretty simple. The question we just worked out. Here, the only interesting adjustment I would say was relating to this part, the loan part. So here, because whenever we worked out a question, we have always worked out questions only with monthly payments. So this was the first time we came across with a question with a quarterly payment. So that was interesting in this question. All right. If you look at 3A, this question I did not find it any bit productive, because this question is something which we all anyways work out in class. And then question number 2, if you see, the residential status question was a very interesting question. Question number 1 was a typical total income question. Okay, let's do question number 4 now, right? We just have, this is just the last question which has 2 subdivisions, 4A and 4B. 4A is a set off and carry forward question, and 4B is a chapter 6A question. Okay, so both are simple questions. Let's finish them. Question number 4A first. Now, whenever we get a set off and carry forward of losses question, what I generally do is that I consider just my incomes first. I keep all the losses aside. Once I finish all the incomes, then I consider the losses one by one. I'll show you how I do it. Compute gross total income of Mr. Farhan and show the items eligible for carry forward and the assessment years up to which such losses can be carried forward from the following information furnished by him for previous year ended 31st March 2021. We're supposed to compute his GTI. So write down computation of gross total income of Mr. Farhan. We are doing this calculation for previous year 2021, assessment year 21-22. So make a 3-columnar table, a broad particulars column. No, not a 3-columnar table, just make a particulars column and a broad amounts column. That's all. Okay. All my losses I will keep aside, just my incomes I will consider. So loss from speculative business, I'll keep this aside. Income from speculative business. So under PGBP, I have speculative income of how much? 25,000. Then we have loss from specified business. Loss again, I will keep it aside. Then we have salary income computed. Computed means they have already subtracted standard deduction and all from this. Okay, salary income is 4,18,000. So leave some gap, leave some 7 to 8 lines. Then write down salary income. What is our salary income? 4,18,000. Okay, then loss from house property, I'll keep this pending. Income from trading business, even this will go under PGBP. Trading business means non-speculative. So non-speculative income is how much? 2,80,000. Then we have LTCG from sale of urban land, 2,05,000. After salary income, again I will leave some gap. And then LTCG from sale of urban land. So this LTCG will be 112A LTCG or 112 LTCG. Sale of land, section 112. How much is it? 2,05,000. Then long-term capital loss on sale of equity shares, STT not paid, 85,000, STT not paid. So this will also be 112 loss. Then we have one more loss, long-term capital loss, sale of listed equity shares, STT paid, So section 112A loss we have. So we have two losses over here, two long-term capital losses. One is section 112 loss. Why 112? Because STT is not paid. And another 112A loss. Then we also have short-term capital loss, 85,000. And then apart from all these losses, we also have three brought forward items. Brought forward items we always consider later. First, current year. Current year also first intra-head, only then we do inter-head, isn't it? First intra-head, within the head. So loss from speculative business, tell me, is intra-head possible? Speculative loss can be adjusted only against speculative income. Do I have speculative income? Yes. My loss is 12,000, but my speculative income is 25,000. So I can adjust this fully. So less speculation loss. I am actually adjusting this speculation loss against speculation income. So how much am I adjusting? 12,000. Okay, so this time done. Then 35 AD loss. Is intra-head possible? No. 35 AD loss can be adjusted only against 35 AD income. Do I have any 35 AD income? No. So I have no choice. I will carry it forward. So after this entire solution, write down section 35 AD loss. How much is it? 45,000. We have no choice. We will carry it forward. Carry it forward to be adjusted against what? It can be adjusted against section 35 AD, profit only. And for how long can we carry forward 35 AD loss? This can be carried forward indefinitely, right? 35 AD loss can be carried forward indefinitely. So even this we are done. Now coming to house property loss. Tell me, house property loss is intra-head possible? No, because we don't have any house property income. So we'll keep this pending. First intra-head we will finish. Long-term capital loss is intra-head possible? Very much. We do have LTCG. So from this we can subtract both our long-term capital losses. Our 112 loss also we can subtract. 112A loss also we can subtract. This is a very common doubt which students generally have, that whether we can subtract a 112A loss also against LTCG income. Yes, even 112A loss can be adjusted. Okay, so what is my 112 loss? 85,000. And what is my 112A loss? 1,10,000. After adjusting them both, how much money, how much LTCG are we still left with? We are still left with 10,000. We have short-term capital loss. So these two we finished adjusting. Short-term capital loss 85,000. Can I adjust this 85,000? Do you remember the provision for STCL? Can STCL be adjusted against STCG or LTCG? Yes, LTCL only against LTCG. STCL can be adjusted against STCG or LTCG. So short-term capital loss, we have 85,000. Out of this, 10,000 I can adjust. So I will be left with 75,000. So less short-term capital loss, 10,000. So we will be left with 0. You know what is a very common question which students have? Section 112A, had it been income up to 1 lakh, it would have been exempt. So students generally ask, so in that scenario, should we ignore 1 lakh income and consider only 10,000? Nothing like that. 112A loss treated just like any other long-term capital loss. Okay, so this entire LTCL, 112 and 112A, entire LTCL can be adjusted against LTCG. So after all this, we are left with only two losses, two current year losses. Loss from house property and short-term capital loss. Short-term capital loss, inter-head is not even possible. STCL only against STCG or LTCG. So balance 75,000, we have no choice, we will carry forward. So short-term capital loss, 75,000. This will be carried forward to be adjusted against what? To be adjusted against STCG or LTCG. For how long can we carry this forward? We are allowed to carry this forward for 8 years. Okay, this is about STCL. So we are left only with loss from house property now. Loss from house property, we can adjust against salary income also. We can adjust against PGBP also. How much is the loss? 2,20,000. But tell me, inter-head adjustment of loss, what is the maximum amount possible? Does anybody know? A loss from house property inter-head only 2 lakh maximum is allowed. So let me adjust it against salary income. You can adjust it against PGBP also. Doesn't matter. I am just adjusting against salary income. So salary income loss from house property only 2 lakh I can adjust. I will still be left with another 20,000. The 20,000 I will carry forward. So loss from house property 20,000 I am left with. That I will carry forward to be adjusted against what? Next year you can adjust only against income from house property. And for how many years am I going to carry it forward for? We will carry it forward for 8 years. Is everybody clear with this? Understood? Okay. Let's proceed then. So after this, now we are left with just brought forward losses. So brought forward loss from speculative business. It belongs to assessment year 17-18, which means it belongs to previous year 16-17. Speculative loss has a life of only 4 years, which means it can be carried forward only till previous year 2021. What is our current previous year? 2021. So this is the last year in which we can adjust the speculative loss. How much is it? 18,000. Speculative loss can be adjusted only against speculative income. We had 25,000 speculative income. Out of this 25,000, 12,000 we have already adjusted. We are left with only 13,000. So even though we are bringing forward 18,000 speculation loss, we can adjust this speculation loss of previous year 16-17 only how much? Only 13,000 we can adjust. After 13,000, we will still be left with 5,000. That 5,000 will lapse. Why will it lapse? Because this 18,000 belongs to previous year 16-17. It can be carried forward only for 4 previous years, which means it can be carried forward only till 2021. And current previous year is 2021. So 2021, whatever we can adjust, fine. Beyond that, balance will just lapse. So 2021, I do have speculative income of 25,000, but I already adjusted 12,000 against current year speculative loss. So we are left only with 13,000, only that much we can adjust. Balance speculation loss of 5,000, this will simply lapse. This belongs to previous year 16-17. It will lapse because 4 years are over. Okay, so this is about my speculation loss. Then brought forward loss from trading business 12,000 relating to assessment year 15-16. Assessment year 15-16 means previous year 14-15. I can carry forward other business loss for 8 years, which means I can carry it forward till 22-23. Current previous year only 2021. Well within the 8 years limit. 12,000. This can be adjusted against my PGBP. I have enough PGBP. So less business loss belonging to previous year 14-15. How much is it? 12,000. Even this we can adjust. Then we are left with unabsorbed depreciation 1 lakh. What is the rule for unabsorbed depreciation? It can be adjusted against any head of income except salary. We have enough money under PGBP. Here itself we can adjust it off fully. Okay, so how much PGBP are we left with now? Calculate. Do you get 1,68,000? Yes, we are left with 1,68,000 PGBP. Am I right? Salary income, we are left with 2,18,000. And capital gains, 0. So what is our GTI then? Our GTI is going to be 3,86,000. Do you all get this number? Yes, that is all. That is all with this question. Here, this question is testing. See, this question is important because of this adjustment, your 112A adjustment. A lot of students, you know what they will do? Either they will adjust just 10,000 because up to 1 lakh exempt if profit, isn't it? So loss also they will ignore up to 1 lakh. They may make that mistake. Or students may think 112A loss only against 112A income. So these are the possible mistakes. The biggest mistake possible over here is relating to this 112A loss. But remember this statement. 112A loss, treat it just like any other long-term capital loss. If you remember this, easily you will be able to work it out. The rest of the question is pretty simple. We are going to carry forward 3 losses. 35 AD loss, short-term capital loss, and loss from house property. Is this clear for everybody? Yes. Any questions? Can we go to the last question now? All right. We have one more question. Subdivision B. This is a very simple question. It is just talking about Chapter 6A deductions. Here, maybe some complication may be relating to ATCCD, but if you know the section, it will be easy. Compute deduction available to Mr. Dhyan Chand under Chapter 6A for assessment year 21-22. Mr. Dhyan Chand, aged 65 years. Notice he is a senior citizen. He is working with ABC Limited. His income comprises salary of 18,50,000 and FD interest of 75,000. He submits the following particulars of investments and payments made by him during 2021. They are just asking us to find what is a deduction. They are not asking us to compute his income and all. They are just asking us to find what is his Chapter 6A deduction. Okay, so give the heading computation of deductions under Chapter 6A for Mr. Dhyan Chand. We're doing the calculation for previous year 2021, that is assessment year 21-22. Okay, please remember he's a senior citizen. All right, his salary income is 18,50,000. FD interest is 75,000. Tell me at this stage, does any section come to your mind? His FD interest is 75,000. Senior citizen FD interest, we get deduction under 80 TTB. But what is the maximum deduction you can get under 80 TTB? Only 50,000. So he's earning 75,000 interest, but we will give him only 50,000 deduction. Is this clear? Yes, 80 TTB should be applied here. Then, deposit of 1,50,000 in PPF. PPF will go to which section? PPF will go to section 80C. So after section 80 TTB, write down section 80C. Under 80C, PPF, how much is he contributing? 1,50,000. Then life insurance premium 62,000. Policy taken on 1st April 2017. Policy taken on 1st April 2017, taken on or after 1st April 2012. What is the maximum premium you can pay? Only 10% of sum assured. But how much did the assessee pay? 10% of sum assured would be only 40,000, but he paid 62,000. So how much deduction will you get for life insurance premium? Life insurance premium, you will get only 10% deduction, and that is 40,000. Clear? 10 policies taken before 1st April 2012, you get 20% of sum assured. On or after 1st April 2012, you will get only 10% of sum assured. So only 40,000 you will get over here. Okay. Then deposit of 45,000, 5-year term deposit. 5-year term deposit also goes to which section, guys? Even that will come to 80C. 45,000, even that deduction comes to section 80C. Okay. Then he contributed 2,10,000, 15% of his salary to NPS of the central government. Matching contribution was made by ABC Limited. So here, contribution to NPS, this will go to which section? Contribution to NPS, this will go to section 80CCD. Right. So 80CCD, employer's contribution goes to 80CCD subsection 2. Employer's contribution. So what is the employer's actual contribution? How much did the employer contribute? 2,10,000. They're saying matching contribution, which means equal contribution is made by employee and employer. Both are contributing 2,10,000. Okay, so they are talking about employer's contribution now. This is the actual contribution. But what is the maximum deduction you will get? Maximum you will get only 10% of salary. Only for central government employee, you get 14% deduction under subsection 2. We are doing 80CCD subsection 2. So 80CCD subsection 2, you will get 14% deduction only for central government employee. Here, not central government employee. So only 10% of salary you will get. This number is 15% of salary. So what will be the deduction? 2,10,000 divided by 15 into 10. 2,10,000 is 15%. What is 10%? 2,10,000 divided by 15 into 10. 1,40,000 is a deduction that you will get. I'll repeat again. 80CCD subsection 2 says, employer makes a contribution to NPS. If employer is central government, 14% of salary deduction you will get. If employer is not central government, 10% of salary you will get as deduction. Salary means basic plus DA forming part. Don't consider commission. Just basic plus DA forming part. So the contribution which my employer has made here is 15%. But only 10% will be allowed as a deduction. So we cross multiply. 80CCD subsection 2 deduction will be 1,40,000. Okay, this is about 80CCD subsection 2. Now, what about the employee's contribution? How much has the employee contributed? Employee has contributed 2,10,000. Okay, listen to me very carefully. Employee has contributed 2,10,000. This 2,10,000, two sections are there. You have 80CCD subsection 1 and you have 80CCD subsection 1B. Tell me, out of these two sections, which one will you apply first, guys? Which of the two sections will you apply first? Always apply subsection 1B first. 1B, straight away you get 50,000 deduction. Under subsection 1, how to calculate? See what is a balance. We contributed 2,10,000. 50,000 we got deduction under subsection 1B. How much are we still left with? We are still left with 1,60,000. So this number, or 10% of salary. What is 10% of salary? We just calculated 10% of salary is 1,40,000. These two numbers, pick whichever is lower. Which is lower? 1,40,000. Did you understand? Nothing new. All this you would have already studied. Employees' contribution, first ATCCD 1B. ATCCD 1B will be how much? 50,000. Then you will get section ATCCD subsection 1. How to calculate subsection 1? See balance, how much contribution you are left with. Compare that with 10% of salary. Pick whichever is lesser. 1,40,000. So ATCCD subsection 1, it will be 1,40,000. Are you noticing why am I writing these numbers in the inner column? Because ATC plus ATCCC plus ATCCD subsection 1 are to be restricted to 1,50,000. That is why I'm writing it in the inner column. We'll handle these sections later. Then after this, it is all ATD, ATDDB and all. We'll finish off ATCCE. What does ATCCE say? ATCCE says section 80C plus section 80CCC plus section 80CCD subsection 1 should be restricted to 1,50,000. Here actually you have 1,50,000 plus 40 plus 45,000. You have 2,35,000 under ATC. You have 1,40,000 under ATCCD subsection 1, but we will restrict this to 1,50,000. Okay, so ATTTB was our FD. ATC here was simple. ATCCD series, this I hope you guys understood. Not a new section. You would have already studied about this. I also discussed it with you all. And ATCCE talks about three things. ATC plus ATCCC, which we don't have in this question, and ATCCD subsection 1. These three should not exceed 1,50,000. So we restricted it. Then after this we have section 80D. On 1st April 2020, Mediclaim premium of 1,08,000 and 80,000, totally 1,88,000 paid as lump sum to ensure his and his wife's health respectively for 4 years. So whenever you pay premium for a certain number of years, then you distribute it across those years. So we have paid lump sum premium, which will be spread across 4 years. So 1,88,000 divided by 4, you will get 47,000 for each year. Assessee was a senior citizen. If assessee is a senior citizen, limit is 50,000, we know. So for section 80D, I will put the assessee into two. I will divide the family into two categories. Number one, assessee and his family. Family would mean what? Family will mean self, spouse, and dependent children. And then another category would be for parents of the assessee. My assessee over here is a senior citizen. So the limit for family will be 50,000 and the limit for parents also will be 50,000. For family, we are getting 47,000 right now. Then he incurred 46,000 towards medical expenses of his father. 85 years. 85 years means what? Super senior citizen, not dependent on him. Doesn't matter. ATD, parents, they may be dependent, they may be independent, doesn't matter. See, if a person is a super senior citizen, he will not get an insurance policy. He will not get a medical insurance policy. Section 80D says, if your parents happen to be super senior citizen, and that is why no medical insurance policy you have on their health, then whatever medical expenses you incur, that you will get as a deduction. So my assessee's father is a super senior citizen, so obviously he will not have a medical insurance policy. So this 46,000 medical expenses he will get as deduction under ATD. Then he spent 6,000 for preventive health checkup of wife. Preventive health checkup has to be limited to 5,000. So here I will write 5,000. Then he incurred expenditure of 90,000 for medical treatment of his mother, being a person with severe disability. Severe disability, how much deduction do you get? Which section are we talking about severe disability? When you have a person who is dependent on you and he is disabled, section 80DD, right? Dependent, disabled. Mother being a person with severe disability, assuming dependent, severe disability, you will straight away get 1,20,000 deduction. Now talking about 80D, here we have totally 52,000. This we will restrict to 50,000, parents 46,000. So section 80D, for family it's actually 52,000, but we will restrict it to 50,000. For parents 46,000. Here we will get totally 96,000. That is it. Now add up what is the total chapter 6A deduction that you get. 80 TTB 50,000, 80 CCD subsection 2 1,40,000, 80 CCD 1B 50,000, 80 CCE 1,50,000, 80 DD 1,20,000, and 80D 96,000. ATDD should be 1,25,000. For severe disability, it's not 1,20,000, it's 1,25,000. So your total will be 6,11,000. This will be the total deduction that you will get under chapter 6A. Clear? ATD, did you understand? ATD for family, totally I'm getting 52,000, but this I will restrict to 50,000. Parents, 46,000. Not medical premium, but super senior citizen, you will not get medical insurance policy. So that case, whatever expenses you incur, that itself you will get as a deduction. Are we all clear? Yes. So that is it with our first mock test paper. We have finished it. We finished the MCQ questions also, and all these descriptive questions also we have discussed one by one. All right, we have gone in depth. I hope all of you are crystal clear with each question, with each adjustment. In case later, whenever you come across any query, please feel free to WhatsApp me and get your questions clarified. I'll put the contact details in the description box. I'll put it below. All right. Sometime during the coming week, we'll also finish off the second mock test paper. There's one more mock test paper, the April mock test paper. Okay. Either tomorrow or sometime else, sometime during this week, we will finish it off. All right. So we'll close over here. I hope the session benefited you all. It would have been a good revision of a lot of concepts, isn't it? So we'll close over here. We'll meet again for the second mock test paper. Thank you, guys.